All right, we are at 10 a.m. Pacific Standard Time here. Bom dia or boa tarde para todos those are our guests who are coming to us from Western Europe. And if you're in Central Europe, God bless you for staying with us so late in the day as well. Are you back there in Switzerland, Jess?
I am. I'm back in Zurich. I arrived a few days ago and fortunately pulling through the jet lag. So no, I'm doing good. Enjoying being back.
Do you get jet lag?
Uh, how do I say this? I get it when I come back here for whatever
Yeah.
reason. When I go to the States, it's usually pretty easy, but when I come back here, it hits me weird. Like I don't get tired, but mentally the fatigue is interesting.
Yeah, I definitely get it. It hits me like a ton of bricks. But I'm a bit of a wimp these days. The older I get, the wimpier I feel. What about you, Ryan? You get bad jet lag. I think when you came to visit me in Portugal last month, you were out for like 2 days, right?
Yeah, well, full disclosure, I get bad everything. But yeah, the not 2 days. I tend to do a hard reset. My sister lived in Thailand for like 5 years, and she taught me, you just push through your first day, no matter how tired you are. Try to go to bed no earlier than like 8 or 9, and that's worked for me.
Yeah.
The problem is getting off the plane in Portugal 10 a.m. and going to sleep. You gotta caffeinate.
Can't do that. You can't do that.
Yeah.
You gotta go straight to the gym. That's my secret. All right. Well, let's get kicked off then. Bon dia, boa tarde once again. This is John McNertney here at Green Ocean Global Advisors, and today we're going to be talking about transfers of money. We are in the business of providing advice, but we provide advice when we are covered by the covenants of our client agreements. So if you are working with us directly, we will give you advice directly, but this material we are about to cover is educational in nature only. If you have not met me, once again, hello. My name is John McNertney. I grew up in California, and I was educated in the Midwest in the United States of America. These days, I live in Lisbon, Portugal, with my lovely family, and I work as a certified financial planner. So I've been in the business for about 16, I think 18 years now, and I provide individual financial planning and investment services with my co-founder here, Ryan Ahrens, the Chief Investment Officer. Ryan started with me back in 2022, back when we were on a hope and a prayer, right, Ryan? And maybe you can give the rest of your bio there.
Yeah, coming to you from Seattle, Washington now. Born and raised in the Bay Area. I studied economics at San Francisco State and am actually pursuing a further bit of education here at University of Washington now. I hold a couple of designations, primarily from the American College of Financial Planning and the Digital Asset Council on cryptocurrency. Yeah, I enjoy the outdoors, woodworking, and animals. We have a little hobby farm. Feel free to ask me all about it.
Hobby farm. I would love to ask you more about it, but I don't know if we'll have time today because we have a third person in tow. Jess Roberson is a American coming to us from Switzerland, which, given the context of talking about money, is, I think, fascinating. If you don't know this, Switzerland is one of the most neutral countries, but also one of the most neutral currencies. And then maybe, Jess, you can give us a few relevant other facts about yourself or maybe WHVP, your firm.
Absolutely. Yeah. So I did my studies in the US on the East Coast and Southern New Hampshire University, where I studied finance and international business. Then I moved to Switzerland with my Swiss wife. That's why I'm here. I got the red card, as they call it in Switzerland, instead of the green card in the US, and have been here ever since. I've been with WHVP for my entire career in the financial world, started as an intern and have now worked my way up to taking care of clients, building portfolios, and helping the business grow in terms of acquisitions. Um, Fun little fact, I played rugby for many years. I've lived all over the world, Cook Islands being one of them, playing rugby out of there. I ended my career playing with the Swiss national rugby team, which was fun, but allowed me now to take a step back and focus on my actual career. And yeah, I'm excited to talk about the currency. You know, John, you said that it's a neutral currency. Not sure if I would classify it as a neutral currency, but we'll get into that obviously a bit later.
Oh yeah, I know. I was just I was trying to be cute. All right, so the outline today. We're going to try to be quick with this. We're going to go over the exchange rates as of today. We're going to talk about multi-currency wallets. We're going to talk about different kinds of orders that you can place with respect to Forex. We're going to talk about some common use cases for Forex and multi-currency wallets. And then we're going to talk about tax considerations. And we're going to let Jess talk about how Switzerland might factor into what we're doing here as well, and give Ryan a chance to regale us with where the stock market might be going. He's brought along his crystal ball for that. So currency exchange rates. Somebody bring the sad trombone out. Obviously, exchange rates for our favorite pairing, which is the US dollar to the euro, are not faring so well these days. We're down about 10% year to date in terms of our purchasing power. Americans in Europe are not surprised by this chart. If you're like me, you're checking this just about every day. You're also not surprised to see the image on the screen here. A lot of the US dollar weakness is very recent, and it's related to some of our policy shifts that we've gone through in the United States. There's a lot of political interference that we're concerned about with regards to the US Fed. That is a story that is in play right now. And so the independence of the US Fed, as well as our ability to be fiscally disciplined, strengthen the dollar. And this year, I believe there has been some question as to our ability to be disciplined and rational. The rising odds of a rate cut in September are still on the table, but the Fed is responding to what the US is doing in tariffs. So we'll see what happens there. So, this is actually a really big rally of the euro, if you look at it from that side. It's the largest rally that we've seen in the euro versus the dollar since 4 years ago. 2001, 2022 saw a similar period. The European Central Bank has signaled that they are going to end their easing cycle as well, which is likely to bring rates down in Europe. And so if you are waiting to get a mortgage in Portugal, hold on. Although, the Portuguese have variable rate mortgages more than they do fixed in any event, but it does look like we're probably going to see lower rates in Europe as well. So why are the currency rates so bad? Well, I just talked about it. Our US Fed's credibility is under pressure. There has been a Middle East de-escalation that has pushed oil prices lower, which has an effect on the petrodollar relationships, and it reduces the demand for the dollar as a safe haven. And it's just normal volatility also. I know that there is this there is this thought out that the US dollar is in a sort of prolonged downward trajectory. Maybe it will continue, but it's also the case that if you look at a larger chart, the US dollar to euro relationship is in it's in a channel. And although it looks awful today, it is common for it to move higher and lower in ways that are sometimes unpredictable. And this makes it hard to do any kind of timing, hedging options. Right. So what I'm writing here is basically we're going to see more volatility. And that sets us up to talk about what it is that we're going to talk about here. How do we manage around the persistent volatility? So first, we're going to go through a tool that I hope that you're aware of. But then again, if you're not, you're about to learn about this. So we're talking about multi-currency wallets. You may already know of these tools. If you look at the little logos on the right, you'll see some of the more prominent multi-currency wallets. They're digital wallets. They allow you to hold, convert, and send currencies within an account. If you have one of these multi-currency wallets, either through Wise, Revolut, sometimes global banks provide these, then they give you sort of a channel through which you can flow money in a very simple way. They're useful, of course, in the usual sort of scenarios where we need currency quickly. Real estate purchases, It's always been amazing to me how quickly we need to fund that lockup account when we're doing a real estate transaction. It has to happen. So we have to have a good tool to do that. Ongoing transfers like your mortgage, your rents, your tuition, etc. Those are going to be ongoing and persistent needs that you can fund. It's interesting when people are receiving equity awards. Oftentimes, if you're getting closely held stock and you liquidate it immediately, then you're going to want to transfer that money to your European bank account as well. And if you have dual residency, it is a good idea in general just to create this easy channel for you. Now, some things to think about. As I was getting ready for this webinar, one of my clients pointed out that they don't keep their money in these wallets because there's no FDIC protection. Okay, so while it's nice to keep the money in the wallet so that you can distribute it when the time comes, it's not going to be FDIC insured. So, caveat emptor, really watch out that the company that you're working for does not hold on to a large chunk for a large period of time. They're not traditional checking accounts. And they also do provide gains and losses. Are you going to make money in this transaction? I hope you do. But just keep in mind that any amount of extra money that you make from the arbitrage there, it could be subject to tax reporting. It's going to be an ordinary income in most cases. Although if you were to hold the currencies for over a year, you could get to long-term gains. But again, we don't really want to do that. So review the fees, of course. Some of these fintechs are cheaper than others, and some of them are much cheaper than banks are. So this is one of the reasons I love these, is they can at times be much, much, much less expensive than banks. And if you approach me one-on-one, we actually do have some partnerships that these guys are forming with us that might give us some additional discounts. That was something I was on just this morning. Why is this trying to get us to use them more? But I won't get in the tank for them unless they make it worth your while too. So why do we use them? They add agility. If you need to get $2,000 by lunchtime, there's really no better option than the multi-currency wallet. Whether you're working with us or with your bank, it doesn't matter. You can basically put this request in, especially if you're in European time, and the transfers are almost instantaneous. You should consider one if you expect currency exposure, and you want to use these multi-currency wallets in tandem with the FX strategies that I'm about to talk about. And so here I put kind of like just a little sort of flow chart where the money would go from. If we're working with you, then it comes from Charles Schwab, and then it's get head through the channel to whomever you bank with. On the Portuguese side, I use Santander, Millennium Bank, BCP. There's obviously so many options, but that's kind of the way that this flows.
Really quick note,
Mm-hmm.
as far as so many options, we actually have a pretty handy handout and comparison chart that we put together for clients. If you're comparing your Portuguese banking options or you're wondering about what you should use, we have a few pros and cons for you to consider.
That's right. We just did a study, an internal study at Green Ocean on the different banks that exist in Portugal. So thank you for reminding me of that, Ryan. One of our associates did that a couple weeks ago. Pretty great. So next order of operations up. So multi-currency wallets are just a tool. It's a Swiss Army knife. Well, maybe not Swiss. That pitches us too hard over to Jess, and it's not his turn yet. But that's like the simple one, and then one level higher in complexity and cost. You're going to have the ability to do limit orders and forward contracts with an actual FX company. And so some of the most sort of salient examples of these companies, I've worked a lot with Spartan Effects. They're one of our partners over here in Lisbon. There's OFX, there's Currencies Direct. This is a different class of company that we're going to be looking at, and they're going to allow us to do limit orders and forwards. They can do transfers as well. If one of them were on the call today, they would probably find it annoying that I'm not mentioning that first, but I use these FX companies in the sense that they're capable of doing more, and these are the things that they're capable of doing. So because exchange rates fluctuate, we need to come up with some response to that, and so that's what these order types allow us to do. Okay, and so just to give you definitions. Okay, limit orders. A limit order is an instruction to exchange a currency when a specific exchange rate is reached. Okay. You don't need to watch the markets every day. So what you're basically doing is you're saying for a period of time, I am going to make a transaction happen at a certain price that I've specified, right? So in an example, we have a client that wants to buy euros when the rate goes from 85 to 86 euros on the dollar. You want that price. You can't get that price until the market moves there, right? But do you really want to sit in front of your computer and wait for the market rate to adjust to the price point? Of course not. And so what you do is you buy this limit contract with a specified interval. For the next 60 days, I'm going to make this transaction happen. And once your target is hit, then you are going to get your price, right? So that's nice if you're thinking that the price is going to go higher. There's also times when you're concerned that the price might move lower. Okay, so if you're a bear, then you can do what's called a forward contract. And this is where you're going to lock in today's rate for a transfer that's a future transfer, right? So this removes uncertainty. This is a hedge where you're going to protect purchasing power from market swings. And so the common uses here is you're buying something, right? Once again, we're talking about a real estate deal, paying a large invoice in 3 to 6 months, planning for seasonal costs that you know are fixed in price, but you don't pay it today. You're going to pay it at some point in the future. These are customizable. And I'm going to give you some examples on this. So I know I'm moving a little bit quickly, but I'm going to give you examples on these two different types of trades. You didn't smile when I put this up, Ryan. I can see you on here. He's my options guy. And so what is interesting about doing these kind of contracts is they're a lot like options. And so when you're doing options, you're either a bull, you think things are going to go up, or you're a bear. You think things are going to go down. And so that is how I think about this, but I'm not going to dither on this slide because it's a little bit little wonky. But what I want to show you is how these limits and these puts work. Okay, so in the limit situation, you're bullish on the future value of your currency pair. Okay, you have an 85-cent conversion rate on the euro to the dollar, and you think things are going to get better. Bless your heart. I want more optimists these days. There's too many of the other kind. So what are you doing here? You're creating a limit order. So for example, we have a US-based multinational corporation. They have euro-denominated receivables from European customers due in 45 days. They're going to convert those euros into dollars, but they think the rate's going to get better. So basically, they just keep the money in their European account. They create the contract sale, the purchase of US dollars, and they just wait for the US dollar pairing to improve. Whenever it improves, the order will automatically click in, and they will get the dollar rate that they're hoping for. The put contract, once again, this is on the other side of it. Okay, this is a bearish decision. The put contract is you're worried. You think that things are going to get worse, and so you want to lock in the price. Okay, and so I didn't put this on this slide, but it's important for you to know that the mechanism for this is different. When you're doing a put contract, you're actually going to be prepaying a portion of that transaction. All right, and so here I've said, for example, you've committed a payment of €1 million in 90 days. You're buying a house probably. You're concerned that the euro may strengthen against the US dollar, and that purchase is going to get pricier. So you go, okay, well, I'm going to lock that contract in now. Then I don't have to worry about currency fluctuations. I did not put it on this slide. I will update it before I send it to you if you ask for it. What it usually requires is about a 20% down. Okay, so think of it as sort of like the down payment itself. You're putting 20% down on that transaction, and then that will essentially lock the contract in. I've put 90 days here in our example, but that is not required. You can actually prepay for various time intervals. The longer you lock in the contract for, as you might imagine, the higher the cost will be.
And yeah, nice. Can I jump in here? I think just another way that I like to think about these with the limit order, it's kind of passive and it doesn't really cost you anything other than, you have to you're interacting with a currency exchange specialist. So even let's take another small step back. Wise, Revolut, those are fintech. They're cheap. It's TurboTax. Where then we go talk to Currencies Direct, Spartan FX, you're talking with a person. That's like having a CPA working on this situation for you. Applicable in a more complex tax situation. And then that's kind of the analogy I would use for these different approaches. Again, a limit order sits and waits. It's optimistic. We are expecting the US dollar relationship to euro to improve. Where a limit contract or the contract approach is something proactive we do now. It's very similar to buying like insurance to protect against something in the future. It's usually a cost if it doesn't go in our direction, but that cost may be well worth it if it's something that's further out, larger dollar figures, things like that. That's all I wanted to add, just as kind of a summation on this slide.
Yeah, I mean, if you need these, you know who you are. Like, this is not something where you're going to go, gosh, should I or shouldn't I explore this option? Most of us don't really need these on the daily, but when we have a large transaction or we have, an ongoing expense, it can be very nice to nail down some certainty with these. Taxes, yes. So some common use cases. Once again, these are regular expenses that you want to be able to sort of foresee and make sure that you're locking down the conversion rates on. So taxes, mortgages, you're dealing with a lot of unpredictability, is what's happening. And this is just another way of getting control over the inherent predictability in currency fluctuations. So some trends to look at, stuff that we lose sleep over. So, I mean, we wonder whether the Fed's going to change interest rates. Those of us in the professional field speculate constantly. I've already sort of, spoke to this. The Fed's currently holding their rates at about 4.25. Ben Bernanke, I'm getting old. Jay Powell said that he was going to reduce interest rates quite a lot more than he has at this point this year. But they are still just waiting for the tariff stuff to cool down. And the European Central Bank is definitely going to be cutting deposit rates. They're going to loosen policy on interest rates. The Fed in Europe has essentially taken the position that if the U.S. is going to stop providing as much support as they have historically, that they're going to become more stimulative. And that is, of course, going to have a positive effect on asset prices in the European zone. Some issues that we look at. Oh, go ahead,
I
Ryan.
was just going to say, perfect. As it relates to currency exchange rates, the main topic of today's webinar, higher rates in the United States usually improve the dollar versus other currencies, right? Higher rates equal usually higher dollar to euro conversion. All this talk about lowering rates, and it's very much in the sphere and expectations. We're expecting a fair bit of rate cutting into 2026, actually. If rates go lower in the US, that actually usually pushes the dollar to euro conversion rate lower as well, right? The idea being, over here in the US, we're paying 4.25. Over in Europe, they're paying 2. That usually flows dollars over the United States. Lower rates could also push down that exchange rate further. So something else to keep an eye out on in the future.
Yeah. And if I can add to that point, that's what we saw heading into 2025 and through the initial stage of 2025. Yeah, the ECB lowering rates, the Fed staying strong. We saw that dollar tick up, almost 10% on the other end from September to January, roughly a little bit further into February. So that, like you said, Ryan, is kind of the historical trend. But I'll get into my thoughts on that in a little bit.
Yeah. Yeah. No, it's really going to be fascinating, Jess, when you start comparing the counter trends that happen in your world versus the dollar world. Some other things that you can think about. I'm sure you're not looking at the central bank digital currencies movements that are happening right now, but There is a pretty broad movement in the world right now to adopt increasingly these digital assets. The U.S. itself has actually been starting to put together a digital asset reserve, and so this is going to be an item that you want to keep an eye on. It's not really clear what impact it's going to have on sovereign uh, uh, cash right now, but it is going to definitely amplify the competition in FX. The U.S. has had the hegemony in the world for decades at this point, and the Chinese especially are interested in stepping up the competition against the dollar. And CBDCs are going to be really central to that story. The climate risk issue has actually also reared its head in the context of FX. Energy security as a geopolitical leverage. It comes in when you start talking about how petrodollars interact with the way that the governments sort of fight with each other over these things. There's a lot of supply chain choke points that are probably going to become more relevant as the U.S. steps back as the world's premier shipping lane defender. And so all of this stuff is actually really sort of involved with the ongoing issues around global dollar movements. Demographics, debt, and structural inflation. I guess we could get into this one-on-one if you'd like to. I wanted to include this slide in case you want to download them from us. And that's another reminder. Please do ask us for that if you'd like to. But without any further ado, Jess Roberson was someone I met. What was it? Last year? No, it was actually this year. This has been it's been a long year. And we were at an industry conference in Austin. I was doing a panel discussion, and then Jess came up afterwards, and he was one of the only people in the room that was not like an American. He's very American. He's about 6'5". Looks like anyone you might meet in Texas. But he he said, "Hey, so we're in Switzerland and we're working with Americans on their money too. And I mean, is there a better time to talk about creating like
Sure.
dealing with this? So did you put this in here, Jess? We're talking about
Oh yeah, of
deflation.
course I
Yeah.
did.
Oh my
Yeah.
God, I
No,
hate this
it's
chart.
yeah, this is my favorite chart because it's if I were designing a water slide at a water park, this is what would exactly be what I'd be trying to provide. However, unfortunately, this is the purchasing power of the US dollar over the last 25 years, roughly. I don't want to spend too much time. Everyone knows this, but we often forget how compounding the running inflation is in the U.S., averaging between 2.5, a little bit more annualized. When you look at that over time, you really see how it compiles and is going to hit your wealth. Now, if we go to the next slide, I want to talk about hedging positioning. So with your futures and your puts, you're talking about more of that hedging option. So what we do at WHVP, we've been working with Americans for over 30 years, founded in 1991. We've continued to work with American, and our business model hasn't changed because the US dollar is losing value against certain currencies. Not every single one of them, as John mentioned earlier. The euro kind of sits in a channel, depending on your time horizon. Where did the Great British Pound go? But what we are biased to, not totally, but biased towards the Swiss franc, shows long-term continual appreciation against US dollar. So hedging is really where I'm trying to, put that put or that forward to buy or sell a commodity, protect against inflation, loss, price, movement. Essentially, I want to try to reduce or minimize risk in one of my bets on the currencies. Positioning is the act of placing or arranging your investments against a certain trend. So we position against the US dollar, meaning we build portfolios totally outside of the US dollar and outside of the US market. So our portfolios are often not involved in US dollar investments at all or the US universe. So that's kind of in general what we do at a very short description. John, if you could
So
tap
I
the
brought
next
you
one.
in just because your expertise is so concentrated in this area, and I just have to ask because I'm sure people are thinking when they look at this, are you doing both of these things on a regular basis, or are you doing more positioning? Is what it sounded like.
We are doing positioning. So for
Okay.
us, there is this, we'll get, it's in one of my slides later, at the very end, but no reason to get it. But this here is a perfect slide to show why it matters. This is a study. When I first came to Switzerland, we're not the only company doing this, but in talking to the other SEC registered investment advisors here in Switzerland, they all said, yeah, we usually tell clients you should move 20% to 25% out of the US, out of your domestic market. Well, I wanted to know why. Is there data behind that? So I found this study performed by Vanguard that shows how much effect reducing your volatility is when you take a certain portion and allocate it outside of your market. And this, as an example, is just the performance of US listed products. So this is if you're in the US and I buy an ETF that says it's a world ex-US ETF or a mutual fund, this is the effects that it has. So it reduces your volatility between 25 and 32, 33%. That's where you get the most effect for your overall portfolio on reducing volatility. Now, for me, I'm a person who likes less volatility everywhere. So if I can reduce my volatility by 3-4%, I'm personally going to try to do that. So we can jump to the next one. So nothing special here. Everyone knows where the US debt is. Kind of a big look. The only reason I show this is the next slide. I'm going to show you why is it that the Swiss franc and the Swiss economy does and performs differently against the US dollar. We see the debt rising essentially since the 80s, with very little respite except during the Clinton years, where there was some reimagining government organization, some consolidation. And since then, we've just seen skyrocketing. A big point here is where we see in 2020, we see the debt kind of come back down again. That's because inflation was averaging 5.5% annualized. So it's easy to pay off my debt if interest rates are lower than the inflation rate. It's cheap. I essentially make money by paying off because I'm losing the value faster, but my interest rate is lower. So we can jump to the next one and I'll show you the Swiss. This is the Swiss debt to gross domestic product. It's been falling since 2002. The reason is Switzerland voted to have a debt brake put in that says the government cannot have more debt than 43% of its national gross domestic product. So it's a debt brake as opposed to a debt ceiling where it's a number that they can keep pushing up. This one is a hard fix that says if you want to spend more money, you either have to cut programs, you have to better allocate. You cannot go above 43% debt to GDP. What that may have made them done is when they surplus, they put reserves aside. So that uptick in their debt to GDP, you see at the downfall, again, same thing like Corona, there's a little bit of inflation in Switzerland, but inflation, I think the highest point of inflation in Switzerland was 3.4%. In the US, it was roughly 8.9%, right around there. Part of that is the central bank, unlike the Fed, has one mandate: price stability. Everything else doesn't matter to them. They just have to focus on the price stability of the Swiss franc.
So the Swiss Fed doesn't care about unemployment?
Nope, that's the private sector's job and the government's job, but the government's capped at 42% debt to GDP, so they can't just keep printing money to try to flood the unemployment rate or unemployment market. It's the private sector and the government figuring out how they can come up with effective ways to actually keep unemployment low, which it is low in Switzerland. So we can jump to the next. So this is just a quick case study. The last time we gave this, I had a bit more, but I think to keep things current to the point, I just want to give a snapshot picture of kind of the last 5 years. Look, what's the difference between investing in the US and investing as an American in, let's say, Swiss francs? This is very basic, just taking benchmarks. So not really a portfolio that I would like to build, but something further. If you look at the US, 26% inflation since 2019, but stock market up 145%. Not shabby at all. That's one thing that we always say, look, the US has a great investment environment. We're not trying to rip people away from that. There's a great opportunity. But if you make real return, you're at 88%, which is Good. Not bad. That's wrong. Excuse me. 119% roughly, which is really solid. So clearly in updating my slides, I didn't update that number.
I think it's a good rate of return. They're both good,
Yeah.
but yeah,
Yeah.
obviously above 100
But in Switzerland, how has the Swiss franc performed against the US dollar? In that time period, it's gained nearly 20%, 19.35, which is really solid in terms of it's just a currency. There's nothing else beside it. But they don't have raising debt. They have a pretty stable inflation rate. Right now, it's actually at 0. It's actually negative 0.0 or 0.1. And their interest rates are low. So kind of earlier, I mean, the performance of the market was, fine, nothing special at 42. But then you add those instead of subtract it, and you get 62%, which is pretty decent. It's not 120%, but it's pretty stable. And you didn't have quite the volatility of ups and downs that you had in the States, where you had a year of 20% down. So real return, much lower. It's going to be much lower if you were to repatriate the money on that day today. Let's repatriate the money, especially where the US dollar is now. It's going to be a little bit tougher. We can jump to the next slide. And this is what I want to show in how the US dollar has performed in the long term. If you push this scale out another 10, 15 years, the exchange rate keeps going up. So the US dollar back in the 1970s could buy 4 Swiss francs. Now you can't even get 80 cents, 80 Swiss franc cents to the US dollar. And that's where we are today. And kind of to Ryan's point, I just want to add to this. We are in that really weird time period where the ECB is dovish. They've been lowering rates for not quite a year, but almost a year now, slowly. Swiss franc, or the Swiss National Bank, is at 0% interest rate and might have to go negative, because in price stability, the Swiss franc they've been trying to devalue the Swiss franc, but it keeps gaining value. So they're in this fight between it becoming too strong. And so they're looking for that price stability. But over time, if there's ballooning debt and kind of this, how would I say that, geopolitical turmoil, there's 2 assets that have always performed the best in those situations, and it's gold and the Swiss franc. And
I
so
love that you just mentioned also, I mean, that this is something that governments worry about, is their currency being too strong, especially versus the dollar. It is one of the things that American government has done well post World War II. We're kind of the world currency, right? The OPEC dollar and things like petrodollar. Having too strong of an exchange rate can reduce the flow of dollars into your economy if we can't get enough, right? So there is kind of that fine balance. But other just piece of context too. I love you, Jess. The term dovish, think bearish, and then the opposite of a dove is a hawk or a bull, caca. So there you go. All right.
yeah,
But
no, it's good.
To bring it back home though, Jess, the reason that I brought you on here is when we talked, I explained to you that at Green Ocean, we were reducing our exposure to the U.S. market via investment in ADRs on the U.S. exchanges, and you said, okay, well that's nice, but when you're buying European stocks on the U.S. exchanges, you might not get the benefit that you would hope that you would, because you're going to be basically the transfer agents are going to be able to remove the currency benefit that you receive from investing in those euro shares. So you're not going to get what you would hope that you would. Is that really accurate in what you explained to me?
Yeah, so the thing with the ADRs is you have a broker who's sitting in between who's going to charge you a fee for holding that ADR. So how is that? I mean, other than the fee, there's someone in there that has that currency. And so let's say it's a Swiss investment that I bought in, let's say 2020. Well, 2022. Well, at a certain point in 2022, the US dollar and Swiss franc were at a 1-for-1 par. And so, okay, I've bought that ADR, let's say for 100 US dollars, and it was 100 Swiss francs at the time. Well, 100 Swiss francs today is almost 120 US dollars now. And so that issue that you get is you didn't get any of that benefit. the broker did, and you're paying the fee to the broker to hold ADR. What we do is we open up bank accounts in Switzerland and Liechtenstein, totally compliant for Americans, whether they're living in the US or abroad. And then we invest directly at the market. So that same ADR that you would have in the US, we have bought the company directly at the market where it's sold. So you get it in its currency and it's referenced against the US dollar. So you get the currency and the performance against the US dollar in that title. And so that's where it works a little bit different, similar to an ETF or a mutual fund that's a ex-US, ex-US market, US dollar even. But if you buy it in the US, everything's listed in the dollar. So you're still not diversified on the currency level, although you might be holding the diversified or global company.
Interesting. Okay. Well, I mean, that is something that I think that bears further examination. Not today, don't worry. I know that we've already gone down enough rabbit holes for you if you're still with us. But as we move along here, we'll get into the Q&A. Ryan's going to always bring us up to date with what's happening in markets, though. Markets are pretty sanguine right now, right, Ryan?
Yeah, so yeah, thank you guys so much. Before we jump into the quilt chart, Jess, what is a franc cent? What do you call that? I'm just curious.
The franc set, excuse
Yeah,
me.
like
Yeah, what is 1 cent in your
what is 1 cent?
It's called a rappen.
A Robin. Oh, excellent. I was
Robin,
hoping
yeah,
it would have a
Robin.
great name. With that said, here we are looking at the quilt chart. So this is different sectors, focused mostly on the United States. However, developed markets is in gray, right? So this is year to date 2025 right over here. Gray right at the top of the pile. I have more context for us to consider in just a moment when we also look at the currency conversion rates, like the fact that the dollar does not buy that many euro right now also boosts this return. So that's, I do find interesting. Emerging markets equity, think India, China, Brazil, high yield, on and on and on, US large caps. Now this was at the end of, or halfway through June. It's been on a bit of a run since. Let's go ahead and go to the next slide, please. Dollar to euro, please go. Yeah, thank you. Here we go. So what we're looking at here is the Eurozone, China, emerging markets, Japan, United States. This is year to date, up until I think a couple of weeks ago. At its core, the actual growth of the European market is here, and that big purple chunk is the fall of the US dollar versus their currency. Okay, same thing's going in Japan. In Japan, you're experiencing a stock market that's up single digits. From the American lens, looking at it from US dollars, it's up 12% year to date. This really, I think, throws a spotlight onto the pretty big swings we can see when your currency is falling relative to global currencies. On the right does suggest, what does this mean? Are we too late? Are we too late to the party? It's up 28%, 29%. No. From a multiple standpoint, when we invest like Warren Buffett or Benjamin Graham from The Intelligent Investor, a good book for people interested in fundamental investing, I think it's, you know, it's rather attractive to a portfolio manager like myself. In the US, we have, I think, a very technicals-driven market. You know, the Magnificent Seven, these names that have a lot of momentum, they have really high earnings multiples, meaning that they've got to kind of earn strongly. They got to grow because we have this high price to earnings ratio market wide right here of 21 times. Everyone else is under 15. That's attractive from a fundamental standpoint. It looks like these guys can make some growth happen in a more, I'd say, predictable way. So we're really not too late to the party here. This is still a viable investment at this time. I would add that Green Ocean was positioned a little light on its European and international exposure from 22 through 24. Early part of this year, we changed our tune on that, and we're aiming for 20 to 25% of your stock to be overseas, in large part because of this. Here's a big one too. Very rare we get direct guidance. The European Union said, we're going to inject $1 trillion into our economy. That's a nice headline for us to focus on, and we can see what has happened to some of the top European defense stocks here on the right. I did include this rather chunky quote from Dwight Eisenhower talking about the establishment of the military-industrial complex in the 60s. You can read that at your leisure and when you get the slide deck. But the point is, any ethical considerations aside, that's a lot of money getting injected in for European defense purposes. One more click, John. This is going to show us a chart of, oh, I guess we lost that chart. I can come back to it, but yeah, that sector in Europe has outperformed by a pretty wide margin.
Yeah, I think Germany itself actually is up like 18% year to date right now.
Yeah, quite a bit, quite a bit, and that's before the currency conversion, I think, too.
Yeah.
Here we are as far as U.S. markets. Actually, the first time we did this webinar, we were up much smaller. We're getting close to double digits on the year. Doesn't mean that we're going to stay on this exact trajectory. Let's not forget, this is just year to date, so let's not forget how low we got back in April. This represented over 20% down in NASDAQ, and the S&P 500 in blue touched 15%. And then, we got liberated from Liberation Day, so we're double liberated now. Then we've got up 9 at this point, with industrials lagging a little bit. That's tail of the tape these days. One more click, and we're gonna, I think, get into Magnificent Seven. So the Magnificent Seven, the top 7 tech stocks, and we've got, before John asks, Google, yeah, Google, Facebook, Amazon, Apple, Microsoft, Nvidia, and Tesla are the Magnificent Seven.
That's
Tesla
7.
being the main loser this year. However, thank you.
However, he had the question in advance this time. Damn
I
it.
did. So we can see though, right? This is we kind of get a little tail wagging the dog. Most of the companies I just named are worth over $1 trillion. Just for context, I mean, things are looking pretty wild for me here. The first company to be worth $1 trillion was Apple in 2019. There are now 6 companies worth over $1 trillion. Apple's close to $3 trillion, right? So in 6 years, it's pretty wild, the tail of the tape there. And we can see that in the S&P 500, they actually comprise about 21% of the returns this year. Earlier, when we looked at this chart, they were dragging the whole thing down. But we can see with so much concentration of value in those companies, it's kind of watching them, and everyone else is a bonus almost. So yeah, go ahead and hit the next one. Again, these slides will be available. No change in the interest rate. That's why I left it on the May chart. If I pulled it again, June one says the same thing, 4.33% from the Fed. I do often do this, but let's just run through. This is a 25-year chart. This is what the Fed's trying to do. Hey, we've got runaway growth. We need to moderate that by increasing the interest rate. Then a good fiscal policy says, okay, once we hit our target inflation, right now the Fed wants 2.5, we're going to start dropping the interest rate. But a gray bar then represents a time that the market, the US stock market, was in a recession. So this usually means, okay, now we got to cut the rates a lot to stimulate the economy again, and then repeat, and this is looking oddly similar. Now, that said, I want to say that Jerome Powell really appeared to be leading us to a soft landing, potentially the first one we'll have seen in about 3 decades. Remains to be seen. His seat is up for grabs whether or not he's pushed out early next year. Latest news I've seen on that, because that's gone back and forth, is that the Supreme Court continues to block the president's ability to just remove him. Even though he appointed him, he seems really eager to do that. That's the rest of my stuff. I'm all set.
All right, folks. We are into Q&A. If you have some questions that you've been noodling over, now is the time. If you haven't talked to us and you want to talk to us about what we do every day, this is where I'm going to mention pre-move and acclimation. If you want to do financial plans with a financial planner, talk to them soon. Talk to them sooner rather than later, because we hate getting that phone call. I'm moving to Portugal in August, and I need to figure out if I'm going to do anything. No, talk to us in the pre-move phase, so that we can go ahead and collaborate on just what you should be doing. Surface issues that are going to be a problem before they become a problem. But yeah, this is your chance. If you have some questions, shoot them into the chat here. Otherwise, we are going to wrap it up. I know you've been very patient. This is somewhat of a wonkier presentation, but we are here. We are here to help. Let's see. I will ask one thing, Jess, because last time we got this question are you really able to open up an account for Americans in Switzerland? Because like there was a time where that was no small thing, right? That's actually difficult to do.
I would say it's still difficult to do, but it is pretty straightforward. So we've been opening accounts, as I mentioned, since 1991 in Switzerland for Americans, and we've opened up accounts every single year that we've been in business. That includes during the scandal that went through, but there are some requirements. So one, there's a minimum investment requirement that's going to be 500,000 US dollars. So these services are for your high net worth, or I would say budding high net worth people. Fees are going to be a little bit higher than what most people are used to, because you have to have a registered investment advisor that's going to have 2 licenses, US and Switzerland. And then the banks that you're using that we work with are top tier private banks. So it's not going to be a JP Morgan Chase. It's not going to be a Bank of America. It's not going to be even like a Charles Schwab. These banks are set up to serve clients privately. So what that means is higher liquidity ratios, less risk taking in their investment departments. One of our banks doesn't offer mortgages, period, even to the family that owns it. We want to work with banks where we are interacting with their top executives, if not the owners themselves, so that there's leverage that we can essentially solve problems for clients. If there's any issues, we know that we don't have to worry about middle management or anything like that. We can go directly to the source. So yes, these come at a price. You're not getting a free toaster or $200 deposited in your checking account. Shucks. But you're paying for the security of the bank and the privacy of the bank. Again, these are not avoiding taxes banks accounts. These are adding diversification and the level of privacy, because there's very strict confidentiality between me, the bank, and how we have to keep that data. Just like a lawyer or a doctor in the US, all of that information is strictly confidential on punishment of prison time. For me or for anyone in the company working, serving people. And so because of that, you have to have high levels of data protection. You have to have high levels of cybersecurity wrapped around everything that you're doing.
Yeah, I've definitely experienced a fair share of that, my share of that as well. GDPR considerations are paramount and different than US privacy considerations. An anonymous attendee asks, does Wise or Revolut count as a bank account for Portuguese immigration purposes? Now, I would just throw back to you, what do you mean? I don't know. It's not a bank account. So if the question was to stop right there, just remember Wise and Revolut are a fintech platform. Yeah, that's a mouthful, isn't it? I mean, for anybody born before 1975, if you're squinting at the screen just like me, like, what? A fintech platform? They're not a bank account. So don't think of them that way.
They're not designed to hold your cash for long. They're designed to help you transact your cash between the two banks. So if that's a question about, I know there's some like account information requirements during the immigration process. This should be pretty short term, right? They're not really designed to hold the resources for long.
Yeah. David asks, this is a good question, David. You teed me up. He says he has had issues with Wise and their authentication procedures and getting some client service attention. Now, when I had my call with Wise Corporate this morning, that was actually my big question to them is can we actually get a dedicated phone representative to help us through issues? To which they said yes. That was a coup for me. So yes, our clients will actually be given a dedicated support number that they can call directly into. How about that? So I'm not trying to show off, but that did make me excited. DB asks, isn't Wise FDIC with the US bank? Yeah, actually they are. So I wasn't going to bring that up, but he makes an important point that Wise does actually provide FDIC insurance on deposit balances where you elect to hold them within the money market that's associated with one of their US banks. So it's an option. It's not the default, but yes,
And
they do extend FDIC insurance to some US dollar denominated
the
accounts.
main critical thing, right? The goal of Wise is to move your assets into euro. The minute that it's not USD, FDIC insurance cannot apply.
Yeah. So just keep your eye on that one. That is a good question though, DB. I appreciate that. We get the rest of our day back, don't we, gentlemen? All right. Well, you've been very kind, both. Oh, I want to take one more question because I love Suzanne. Why would I want to use Santander versus one of the Forex accounts? Why would you indeed? Santander versus one of the Forex accounts. Well, I'm assuming here what Suzanne is asking is why might it make sense to use Santander? Well, I use Santander to bank, right? And so if I had a Santander account in the US and a Santander account in the EU, I can imagine where there might be a benefit to that. They'll probably give me preferential treatment, preferential rates. Yeah, it'd be easier. And HSBC does that. If you're gonna live in China for half the time and you live in San Francisco, I know that there's a relationship there as well. And that was why on the page where we talked about these multi-currency wallets, I did bring up a couple of these different banks. Banks will, from time to time, offer these services to their customers if their customers meet with certain special criteria, like,
And a financial planner hat on for a moment. Just as a concept, usually a good idea to have about 3 months of your expenses in your most easily accessible bank account. If you're in Europe, that's a European bank account, not your US bank account. Now, because of these availability of these fintech platforms and how quickly we can transfer money, I could understand, hey, I could just transfer when I need. But look at what's happened with exchange rates. If you were doing that in December and you built up 6 months of cash, you were converting almost 1-to-1. Today, 85 cents to a euro. So there is an advantage. We're not asking you guys to try and play, our clients to try and play that currency conversion game. Rather, often it makes sense to just have that little bit of buffer in your European accounts, and we can discuss with you kind of the best ways to approach that.
Yeah, that's a great point. All of the conversations we have, whether it's investing or currency conversions, we hope happen within the context of a plan, right? Because it makes sense to do anything in our lives with consideration to where we're going to be in 5, 10, 20 years down the road. That's the planner hat that we usually wear. Anyways, guys, awesome to see you. Always wonderful. If anybody has any questions, you know exactly where you can find us. And stay tuned. We're going to be doing some additional research projects in the future. If you have projects that you'd like us to dig into, don't be shy. Let me know too. I'm always coming up with new ideas. And I'm not a genius. Jess, you raise your hand.
Yeah, I just wanted to say, for anyone interested, John was actually on our podcast, and the episode will be being released next week on Thursday. So if you guys want to find that, to watch John tear it up in Zurich, you can just search WHVP on YouTube, and you'll find it. The episode should be published, so Thursday it'll be up for you guys in the morning. Thursday morning next week, so the 31st of July. And it was a great episode. Thanks for coming out to Zurich, John. It was
anytime.
I'm looking forward to getting it released.
That's awesome. Thank you for letting me know. I'd forgotten that we did that. So we'll be sure and boost that on our website as well. All right, sir. Be well. Everybody else, have a great week.
Thanks,
and
everyone.
we'll talk to you next time. All right. Bye.